यहाँ पे मैनी कैम पे जाऊँ?
नहीं नहीं।
ये चलते रहेगा। अच्छा सुनो, एक मिनट, मुझे यहाँ से बताओ। मुझे यहाँ से वो बंद करना है, म्यूट करना है, म्यूट कर दो। Good afternoon, Mr. Gupta.
Hi Shivani, how are you doing?
Good, sir. How are you? Pleasure to have you.
Same here. It looks like your voice is echoing to me, or
Yeah, it is echoing. I'm just. Is it okay now?
yeah, much better.
Thank you.
Wait for others to join. Shivani, whenever the time comes, you will allow me to share the screen, right?
Yes, sir. You already have the rights.
Okay. I thought that sometimes you have to pass on the rights.
If you want to do a like test check, you can do it.
Okay, just let me see. Can you see that now?
We can see. We can see.
Okay, fine.
Yeah. Thank you.
Okay, thanks.
Good afternoon, sir.
Good afternoon, Vani.
Mr. Amit has also joined, sir.
Acho, hello, Amit.
So, how are you doing?
Very well, आप बताओ.
Best ठीक है. Unfortunately, in person, not meet, but yeah, still better
आजकल
than not meeting at all.
Busy हो गए, audit season चल रहा है.
Yeah. So all the listed companies. So that's why I think our WhatsApp was also a little erratic this time around. Otherwise, I'm generally more prompter in responding.
No, not an issue because I can understand. So you are looking at any particular verticals?
Yeah. So I look at more in terms of renewable power. So power and utilities. I lead the assurance sector for UI.
Okay.
So pretty much all the renewable power, and then North India real estate and infra. So the real estate
power में renew के आप auditor हैं?
Yeah, Renew का मैं quality reviewer हूँ, but Renew Azure I look at overall in terms of Hero Future Energies. तो दिल्ली से कई सारे हैं अपने पास. AM Solar ऐसे करके Continuum हो गया बॉम्बे से, पुणे से Spring हो गया. So generally the whole sector kind of a thing I look at. And of course now we do Adani Green, Tata Power, Adani Power, all of them. So very large presence on that one. I don't know if the participants hopefully can't hear this conversation.
No, they can't. Shivani?
They can, sir.
Okay.
So I'll just put myself.
Vikas is also joining.
Good afternoon, sir. Hi, Amit. How are you?
Hi, Vikas.
Hi, Shivani.
Good afternoon, sir. How are you?
Good afternoon, all my friends who have joined. We wait for the others a little while. Start.
Yes, sir. So we can start in 5 minutes.
5 minutes. Okay. So just a quick one, Shivani. Presentation. You've given the rights to Amit and
yes.
Vikas?
They both have rights. They can run their presentation themselves.
Okay. ठीक है. Good.
How many people are expected to join, Shivani?
We have 300 registrations. So that's why I requested our chair to wait for another 5 to 10 minutes because, and moreover, CARO is a very hot topic, as you all know, sir. And I've got so many calls regarding the topic कि आपने ICSI के साथ join नहीं किया credit hours वगैरह के लिए, but their reply came too late. Otherwise, we would have.
फिर कर लेंगे, we can do it again.
Yeah.
Not to worry. We can start in about 2 minutes, Shivani.
Yes, sir.
Okay.
Can we start, sir?
Sure.
Good afternoon, everyone. I welcome you all to the webinar on CARO and recent amendments in Schedule 3 of the Companies Act. We are joined here with our chair, Mr. Suman Chadda. He is chair of Corporate Affairs Committee of PhD Chamber of Commerce. We have two esteemed speakers with us who would be throwing light on the mentioned subject. Mr. Amit Gupta. He represents SR Batley Boy and Company LLP. And Mr. Vikas Kumar, he's partnered with TR Chadda and Company. First of all, I would request our chair, Mr. Suman Chadda, to throw some light on the theme. Over to you, sir. Sir, you are on mute.
Can you hear me now?
Yes, sir.
Yeah. So good afternoon, Shivani. Thanks, Shivani, and good afternoon to all my brothers and sisters professionals. As we all know, the Ministry of Corporate Affairs has, with an objective of increasing transparency and providing additional disclosures to the users of these financial statements, they amended the CARO and also the Schedule 3 to the Companies Act. So CARO 2020 came in, and then Schedule 3 amendments came in. Both were trying to sync with each other, and they are applicable from accounting year 1st April 21 onwards. What we see is the corporate world in the last few months has been gearing up to provide this additional information. There are a lot of new clauses, complicated interpretations. They're also in the process to realign their financial statement closure process, because then the ERP systems and how the data is collated, whether it is multi-locational or multi-entity wise, it becomes a challenge. And then how to link it with their respective internal control over financial reporting, those modules, that again becomes a major task. So it's been a continuous, strenuous effort for all us accountants as well as the auditors. And I'm aware that there have been plethora of webinars and seminars on this subject. But I can assure you, my friends, who logged in on this hot and sultry Friday afternoon, that our speakers today shall be bringing in a very new perspective to these subjects, very insightful. They will cover the nuances, not only to a stage where you can understand and all your doubts will be cleared, but in a very interesting format. I'm also confident that after the presentation by eminent speakers, many of the doubts and ambiguities shall vanish. We have a separate Q&A session after that, so we can address them specifically also. They could be linked to one speaker or general to the panel. And whether we are from the corporate world or from the professional side, I'm sure we'll be immensely benefited from these afternoon deliberations. My friends, the changes in the MCA have been far-reaching. One, they are applicable to interim financial statements, so some of them already gone through that process. Then the consolidated financial statements applicable to companies following, and also companies following 31st December as a year end for financial reporting. Similarly, the spectrum of items of changes is pretty wide. For example, in the balance sheet, it covers so many items, promoter shareholding, statement of changes in equity, trade receivables, other financial assets, fair value of investment property, loans and advances, trade payables, Benami property, relationship with struck-off companies, current maturities of long-term borrowings, etc., lease payments, capital work in progress, intangibles, title deed issues, utilization of borrowing, etc. Some of them can be very complicated. Some of them are relatively simple. Both have to be distinguished. And some of them also leave a lot of scope for interpretation. Similarly, in the P&L, we have undisclosed income, grants, donations, CSR, cryptocurrency, the new animal in our virtual rooms, and also, of course, disclosures of willful defaulters, satisfaction of charge, layer of company compliance, ratios, more of accounting work, and of course, approval of scheme of arrangement or rounding up. My friends, what I have seen practically is, when CARO amendments are there, or when there is an amendment in the audit report format, etc., all the corporates assume that the auditors will take care of it. But now at this stage, once we interact with the clients, they realize that a lot of homework they have to do. So the whole exercise is centered around educating the client, getting into a huddle room, carrying out presentations, hand-holding them so that they can build up the information flow in the required formats. Because until that is done effectively, their work is to bring up the financial statements, as well as professionals who are to attest their function, will also get very onerous. So the more we engage with the clients and educate them on the requirements and clear the doubts specific to the industry or otherwise, it becomes very difficult at the last minute to try and compile something for which data is not fully available. Under the CARO, there are more than 50 areas of focus. The new areas, modified areas, dropped areas, something which was taken out has been brought back inside. So there has been a lot of changes in that as well. And that also increases the responsibility of the auditors significantly. The cost of audit is going up, the cost of compliance is going up, and the cost of non-compliance is going up. So all that has to be done very carefully. We also have to, as if you are a professional, you need to understand that the junior most person going on the audit or the junior most employee deployed in the accounts department is fully aware of these changes. Number one, what are the implications to any particular organization? Each will have its own flavor of requirements as well as its own flavor of challenges. So all that have to be dovetailed and understood before we actually close up on the audits or build up the schedule for finalization of the accounts. And then there is a consistency required over different subsidiaries, over different businesses, and there may be some interpretations which can creep into some discussions of for which clarification is neither there in the MCA, nor, for example, in the guidance note issued under the ICAI, which is a very comprehensive guidance note, and I was one of the part of that team to streamline, but it is again going with a revision based on the feedback and the first line of audits. In fact, as we speak, the audits for listed companies are being closed one by one the last few weeks, and they will continue till end of the month. And it's pretty stressful for most of you to hear from either side of the table to have come and spending time with us this afternoon. Similarly, the company secretaries who are responsible for compliances in terms of proper disclosures, they would also having a lot of challenge because there are so many other requirements which have added up, like BRSR and corporate governance schedule. The whole framework is changing very rapidly. As we sleep in the morning, we find every day a new notification from MCA. Minor changes, major changes. Sometimes the changes are very innocuous, but they have a far-reaching implication for some of us. So my friends, without taking much ado, let's jump into the program. We have a very eminent speaker, Amit, he's a partner with SR Bartley Boy and LLP, and has nearly 25 years of experience in auditing companies. At the moment, he's specializing in power and utilities, real estate, and infrastructure sector, and has very deep insight into Ind AS and the IFRS standards. He's also a commerce graduate from Shriram College of Commerce, and also special invitee to the Corporate Law and Corporate Governance Committee of the ICAI. So can I request my friend and colleague Amit to start his presentation and take us through the deliberations on this CARO 2020.
Yeah, thank you, Suman. So thank you for a rich and generous introduction, I would say. I think thank you, friends, for coming, as I said, on a Friday afternoon to take a talk about this subject. And I said, I pretty much look in the sectors where CARO has given the most impact, the real estate, the infra, the power and utilities, but that doesn't mean that any other sectors in manufacturing or otherwise would have not got impacted. So I know the audience would be diverse. There will be corporates, there will be people from company as well as on the audit fraternity. Both are equally impacted, I must say so. And I'll try to make it more interactive. So if you guys have any questions, please feel free to put it in the chat box. We will compile and try to answer them as we go along. And let's see how it goes, because my sense is that this is quite, you have heard a lot of things, as Suman said, but this is also going to be an exciting journey to take you through some of these changes. So let me just share my screen. Shivani, let me know if my screen is visible.
Yes, sir, it's visible.
Okay. Yeah, so I think I'll just start with, the whole purpose of why this CARO 2020 came in. I think that the first question comes up, why really was this required, and the current form, or the current avatar. And I think the background for this, which Suman briefly covered about in terms of, the question which the government tried to cover, the MCA tried to cover, was in terms of a lot of frauds were getting reported. Those fraud had diversion of funds, those has unaccounted cash, there was misappropriation of inventories, there were wrong declarations to banks. And the government said there has to be some way to kind of bring this reporting both by the auditors as well as by the company in different form, and how do they address that as a part of the financial statements. And I guess, as I said, CARO is not a very common phenomena across the globe. It is very, I would say this kind of a long form report is very unique to India, and the kind of an extensive reporting we are looking at. So of course, there is we always say, there is an expectation gap which was coming through, but regulator wants more and more information, both from the company on us. So this is an environment of a self-regulation. So they're saying essentially the company should regulate themselves by giving more information voluntarily. And of course, auditors should give more information in terms of how they've done the audit. what are the things they highlighted. So there are various stakeholders like SEBI, RBI, NFRA, SFIU, MC, all wants more information. And that's where CARO got its birth. Of course, there was also wanting to be more accountability and responsibility put on the statutory auditor, saying this is a function under the law and can we enhance their responsibility. Again, there was also a lot of pressure coming, activism coming, a lot of, aghast coming from shareholders, stating that we really do not understand what went wrong. There was clean audit report, there was clean financial statements, and suddenly something goes amiss. So there was this whole pressure from the lobby saying, can we find some reasons of what exactly went wrong? Or are there any red flags which could have been identified early in the years rather than this all coming as a surprise in a lot of companies? So this is where we are, and what essentially CARO has done in terms of, I think Sumanta has briefly summarized this in terms of last minute audit resignations. This is what they want to cover. They want to cover evergreening of loans. This was a hot topic in the news for last year or 2 years. This is maybe the word which we not heard of 10 years back, but now it's pretty much in vogue. They wanted to cover this. The government want to cover about going concern issues. They want to cover about how the CSR fund is being spent. Are there any enough reporting around it? In terms of internal audit, are they doing their function properly? Is there some oversight on the internal audit function by the statutory auditors? In terms of loans and advances to related parties, and of course, whistleblower. So again, the focus was not in terms of there has to be a specific reporting around whistleblower. So we'll talk about all of these things in our next 30 minutes or so, and let's move forward. So CARO 2020, I think in terms of applicability, it has not changed. It is pretty much the same way. It pretty much, I would say, apply to if there are people who are auditing small companies or people who have smaller size companies, it pretty much would apply to all of us. So the limits is only 1 crore of paid up share capital and 1 crore of borrowings, or a 10 crores of revenue, which is a very small number. So we can assume it pretty much applies to everybody. The new CARO applies from 2021. This is the first financial year where the reporting will go out, FY 21-22. And again, as you know, the chair mentioned that there are significant changes. So look at the new clauses. There are almost 28 new clauses. 16 have been modified, 7 have been carried forward, and 1 has been deleted. So there are almost like 50 reporting coming under 21 clauses. So that's quite a bit of work with everybody. Okay, so in terms of clause by clause, I think I'll not spend a lot of time on the simpler ones. So in the fixed asset register, there was this requirement for auditors to comment upon whether the company has proper records in terms of a fixed asset register, and there was not enough focus on the intangible assets. Now the new requirement is for the companies to prepare a register which should be having details of intangible assets in terms of what is the quantity of the software licenses, when it was acquired, what is the amortization, what are the other records around the intangible assets. The revaluation of PPE was never a requirement before. That's again a new addition, wherein the requirement is to say whether the revaluation has been done by a registered valuer. Again, that was not mandatory. Now this is specific requirement has to be made whether it's a registered valuer who's done evaluation. Any amounts of revaluation changes which are more than 10% have to be again brought out. So that again was very important. And just very important thing is most of these changes are also brought into the financial statement. So something like revaluation of fixed asset, the companies will have to make a voluntary disclosure in terms of what changes they do. So it was the initial thought was that it will be only an auditor's responsibility, and my fellow speaker is going to cover all of this in more detail in terms of there is a kind of today a bridge created between the new CARO and the new disclosure in the Schedule 3. And once you are part of this whole session, you will see how the linkages arrive. Okay, so the two big changes, fixed asset registers for intangible and then revaluation related reporting. The next one is, which is again very important. I think this whole concept of title deed, this was there initially saying that if the company has title deeds for all immovable properties, land and building. But I think the question which was missing was what happens if the company has a land or building on leasehold basis. Now, the new reporting is that essentially if the lease deeds are not duly executed in favor of the company, then in that case, auditor will have to report that. Of course, there will be a corresponding disclosure by the company also now in the financial statements. That's a new requirement. But this is again very carefully looked at. What we see practically, a company could be in a retail sector or in a FMCG or somewhere like that. Let's say a fast food company would have 700-800 stores in India. Do they get all the lease deed registered? And whether this word duly executed will mean all lease deeds has to be registered, or they just have to be signed off. Registration will involve a lot of cost. Again, that's something is the challenge a lot of companies are facing as we are talking today, finalizing their annual accounts. Okay, moving on. The next one is around, again, a new clause around the any proceedings pending or initiated for holding the Benami property. So the Benami Property Act actually says if you do any transaction in which a property is transferred from one person to another for a consideration which is paid by the other guy. Again, the company will have to make those disclosures in the financial statements. Also, the auditors will have to do a separate reporting. So the whole idea is this is where newer and newer requirements are coming in. The company needs to set up a whole system to understand and identify that there are no Benami properties, there are no transactions of that nature. And of course, if there are any proceedings in that nature, only then the reporting comes in CARO. The next one around, again, if you move to the next clause, inventory, this is again very important. And as I said, this is not only real estate or infra or power, this is pretty much to every manufacturing company and people who are attending on this call from as part of a manufacturing setup. Now, if you actually sanction any working capital limits greater than 5 crore, which is a very small amount, from banks or financial institutions on the basis of the security of current assets. So you would go take limits on the basis of the inventory balances, you can take limits on the basis of trade receivables or anything. In that case, whatever quarterly submissions are being made to the bank or that financial institution, those have to be compared to the books of accounts and has to be validated, whether your quarterly returns and statements are in agreement with books. The auditors will do that. And if there are any discrepancies, then needs to be reported. Now, you can imagine, if let's say it's a private limited company, we're not talking of really listed companies, but if you are a private limited company, CARO would apply. And now an auditor will have to validate for each quarter end the submissions by the company vis-a-vis what is there in the books of accounts. And the cutoffs may not have been done that properly. That is a challenge. And of course, the company has to now set up a system to make sure that on a quarterly basis, they are doing a book closure to make sure that they meet with, and it can't be a situation that you just report to the bank as it is, and then nobody bothers whether those numbers were really matching with books or not. So that's another big change which is coming. So let me know if I'm going too fast.
No, it's fine.
Okay, thank you so much. Yeah, because always in physical, virtual, it gets little, monologue kind of a thing. So I thought I'll just kind of check. Fine. So on the inventory verification, the next one, this was pretty much there in the last avatar, the CARO 2016, but it only talked about whether the physical verification has been done and are there material differences. Now they've just actually identified what really your material is for them, because they say any discrepancies of 10% or more has to be brought out. And of course, they also are now expecting the auditors to comment on the coverage and procedures of physical verification. So whether the companies had the proper instructions sent out, was there any segregation of duties, were the people who were not part of the physical process participated in it, did they keep their records? So it's just not good enough today for the company to just keep a sheet saying that this was my physical stock as of 31st March, signed by 3 people. They need to create a backup to state that what was sent out, what was the written instructions, who counted, when counted, what was done. And that is how the auditor will comment on the coverage and procedures for physical verification. So that's very important. And again, as I said, I want to make this session not only an auditor focus, but also a company focus, because the responsibility is dual here, right? The auditors will have to validate and report, but it also is the case of the company to get the data points across. So that's a lot of work for both the parties. Okay, the next one, I think this is very important. I think this and the investment guarantees, and there's another clause which are the most fundamental changes. We talked about briefly on the evergreening and others. So today, the new requirement is the company has to make a reporting on any investment guarantees, securities to any companies, firms, LLP, or any other parties. So if there is any investment made by a company, any guarantees given, any securities provided to any party. So it is not really restricted to a section 189, if you know the last avatar would say. It actually would to any parties. If that is the case, then you have to give how much is the amount given, what is the balance outstanding for the subsidiary JVs and associate, and what is the amount given and what is the balance outstanding for other than subsidiary associates in JV. So it could actually cover an employee advance today. It can cover all those, any amounts which are going out from the company. So the idea is we want to see if there are any guarantees, any securities, please give us a reporting. That is what the expectation of the government or the regulator. And then the next very important question is whether any of these investment guarantees or securities are prejudicial to the interest of the company. That's very judgmental, you know, but again, there has to be a proper justification of why it is being done. Previously, if you recall, it was only restricted to the loans. Now it is not only loans, this is all of investment guarantee, security, all the terms and conditions. And you can imagine how challenging it would be to comment on each one of them, whether they are prejudicial to the company's interest or not. Okay, so moving on, the other one is, you know, which was again, just look at from an intention perspective. The next clause talks about, is there any renewal or extension of a loan which has fallen due? If the loan fell due during the year for repayment and the company extends that period of the loan, or they give another loan, a fresh loan to settle an overdue of an existing loan to the same party, all of that has to be reported. This is what broadly the evergreen principle would come through, saying, is that other party capable enough to meet its obligation? That has to become now a part of the audit report itself. The next one is, if you have given any loans without any stipulating any terms, you just give a loan and there are no terms and conditions. They could be repayable on demand, or they just do not have any terms and conditions. All of these loans have to be given, specifically bifurcating between, are they given to the related parties or to the promoters. So again, this is very, important point to just look at each category of loans. So much disclosure which are coming through. So companies will have to set up the whole mechanism, justifying why these are all arm's length transactions, why they are not prejudicial to the company's interest. If there are any repayable on demand loans, those gets reported. If they don't have a term, those get reported. If you give a fresh loan to settle a new loan, that gets reported. So all of that gets into a reporting domain now. Section 185, 186, there is no change there. This was the existing clause which has continued. So I will not spend a lot of time this one. Deposits, compliance with the deposits, there is just added amounts which are deemed to be deposits. That's a new change, but otherwise there's not much change in the compliance with the deposit rule. So that is from the old CARO. They have retained a few clauses, as I mentioned earlier, and this is one of the clause which got retained. And again, the cost record, there is no change. The next one will talk about the payment of statutory dues. Here there is, as the learned chair mentioned, that there are some changes which looks innocuous and subtle, but those who could have far-reaching implications. So if you look at the reporting around the regularity of certain dues of payment, this is where the reporting stays as it was there. If those dues are outstanding, undisputed amounts are outstanding for more than 6 months, that gets reported as well. But the important change they've done is they said, in case any statutory dues referred to in subclause A have not been deposited on account of dispute, then the amount in the forum. That subtle change would mean in the subclause A, this says any other statutory due. And what that would mean is that today, if you have an entry tax case, which was not getting reported in the earlier CARO, you could have a municipal corporation demand, which is under a statutory law. It could be anything on, water pollution, environment pollution. Any of those demands now gets reported. If they are disputed, you have to put those demands into the CARO and the authority. Otherwise, it was only previously restricted to PF, ESI, not only PF, ESI, it was restricted to income tax, sales tax, and those kind of dues. So all those big table which used to come in the audit report will become bigger and larger to that extent. The next one, we talk about surrender of income. And again, this is If there are, during the course of assessments, the company has said there has been any surrender or disclosure of some amounts as income, then the auditor will have to report it in the CARO. And of course, this does not stop here, because if we look at the institute guidance and other things, if there are situations like this, that raises a more fundamental question on the entity's internal control and whether the company's the ICFR report or the control report, as we call it, will be clean in that case, or can it be clean? Because the company is voluntarily now disclosing that they did not disclose certain income during the earlier years. So that raises the question on the integrity of the accounts itself, which could be very troublesome for a lot of companies, as well as their auditors also, I would presume. Moving on, the next one is, there was a big clause around the investment loans and securities. The flip side of that is if the company has taken any loans. Now, there are numerous requirements there where they've asked the companies to report if you have been declared as a willful defaulter by any bank, FI, or lender. If term loans were utilized for the purpose for which it's obtained, if not, amounts so diverted and the purpose for its use. Now, if you just think, why would a company say any amount was diverted? But there is an RBI circular today, which actually says what an diversion would mean. RBI circular actually even says any amounts which are given to group companies would be considered as a diversion. Any short-term funds used for the long-term purpose, it would be considered as a diversion unless that was a part of the sanction. So that is again a very, very risky and kind of an onerous clause on the company to make sure that they do the reporting right to the auditors and auditors to validate this information, because the government expectation is to identify such cases where the money has been diverted. Again, if there are any short-term funds which are utilized for long-term, this was there in the earlier, maybe the CARO before the earlier one, they have brought it back. Then again, another one which is very common, if a company takes any loan to meet the obligation of its subsidiaries, associates, or JVs, then that has to be reported. It's not like a company can become a vehicle to keep raising capital on behalf and keep passing it on to the different companies. The whole idea is to bring this chain into a reporting domain. Again, if you raise any funds on the basis of pledge of securities held in shares, so if you just pledge any shares, that also gets reported. So these are extremely onerous clauses, extremely important, very carefully kind of drafted to be checked, to be validated. And again, as the chair said, this is a lot of work for both the company and the auditors. And the next piece is, are there any defaults? So previously, there were only defaults to banks, government institution, debenture holders, those kind of things. Now they said any defaults in repayment of loans to any party. If you can have an intercompany loan or a related party loan or a group company loan, if you have not paid the interest on time, that technically gets reported now. So again, this is a very important clause where the company will have to list down what is the requirements. They have to set up a control mechanism. Auditors will have to set their work program to validate this information. The next one is preferential allotment and private placement. So there was a reporting around the money raised by that. Previously, only used to talk about Section 42 compliance. Now it also says about Section 62 compliance. So which is something which has to be looked at. There's not a significant change there, but that's something both company and auditors will have to comply with. Fraud and whistleblower. This is again very important, wherein initially, if you look at again, there's a subtle change there. It only used to talk about any fraud on or by the company, by the officers or employees. Now they are just talking about any fraud. What that would mean is any vendor frauds, any agents frauds, all those have to be reported in CARO. Then the next question is the auditor done any reporting to central government as required under 143 subsection 12? That has to be reported in CARO as well. If auditor has gone to the central government and said that we believe there has been a fraud. The next one is whistleblower complaints. So this is again very important. Companies who are not following the whistleblower under the law in the right spirit, they will have to set up a vigil mechanism, and auditors today have to make a reporting on that. So they'll have to make sure that are there any complaints which comes out through whistleblower? How did they modify their audit procedures to address those whistleblower complaints? The next one is Nidhi companies. I will just not spend time here. No change there. Related party, again, no change in terms of compliance of section 177, 188. So those are the 4 important sections for all of you: 177, 188, 185, 186. That's where government has kept those clauses same. And again, very important for all of us to make sure that these 4 clauses are complied with. The next one is internal audit. So this was again brought back with a little bit more detail. It was there in the earlier CARO, removed in 2016, but brought back in 2020. Whether the internal auditor will comment whether the internal audit is commensurate with the size and nature, and also have you considered the report of internal audit. This is a very important one. This is a new one they have brought in, and now that means the idea is the auditors cannot just ignore the internal audit comments, and the management will also make sure what comes in internal audit would have a statutory audit reporting implications also. So the next one is non-cash transactions. There is no change there. Any non-cash for the directors or any persons, that will stay same. Reporting for NBFC. So there are 3 new clauses they brought in NBFC. And again, it could be any company theoretically today with the definition of RBI, which can get into NBFC. So it's not that, oh, I'm not an NBFC, so it's not an, but if you meet the principal business test, you can be classified as an NBFC. If you meet certain criteria, you can become a CIC. So there are requirements around the fact that if either you are an NBFC, have you complied, taken a certificate of registration. If you are a core investment company, then you make certain disclosures. If you are more than 1 CIC in your group, then you have to make disclosures. So again, CIC and NBFC conditions have to be seen on each balance sheet date and per the last audited accounts as the definition go, and make sure that those are complied with. The next one is reporting for cash losses. This is again brought back into the new one from it was not there in the last one, but it was there before that. And again, you know, what has changed in this one, when we do practically audits, the question is what really is cash losses? Should we look from the cash flow statement? There are now plethora of Ind AS and IFRS adjustments, which are really notional in nature. So what gets reduced, what gets segregated? There's still more judgment that was there in the previous Indian GAAP accounts. So this has to be again carefully looked at. So the next one is around resignation. If there has been a resignation, the auditor will have to take into consideration the objection raised and has to make a reporting that he has considered it before taking an appointment. So this is very important. The next one is going concern. So this is very, very typical, because this is where I think the auditor fraternity has the biggest discomfort in terms of whether how would an auditor confirm that the company will be able to meet its liabilities for next 1 year from the balance sheet date. So Institute has come out with a guidance, and Mr. Chadda, as he mentioned, is a part of the committee who drafted something for auditor fraternity to put. But this again would mean auditors are kind of pushed by the government to do more work around going concern assessment and liquidity, which they ideally should have done always, but this becomes a more important push. And the same way the company to look at all the financial ratios, and my learned speaker Vikas will talk about some of those ratios, but that's another piece that they are expecting disclosure of analytical ratios and auditors to factor all of that and then opine what is in the view, is there any material uncertainty around going concern. So the next one is around CSR. So there was again a challenge with the government felt that whether the amounts for CSR are being reported rightly, are they being utilized? So they are just looking at what happens to the unspent amount. So there are 2 provisions for ongoing projects have been followed, this 135(6). If they are not for ongoing projects, have you transfer to special fund? So there are again, factual reporting which has to be done. And 30th April was the last date for for companies who have not actually spent the money to deposit into the specified fund. Next one is on the console. So I think while CARO 2016 did not apply to console, in the 2021, they have required companies to go for consolidated accounts and put all the adverse and qualification remarks. Now, adversity is again a challenge, whether you have any of the statutory delays, slight delay in a few cases, is that something is an adverse comment? Will you bring all of that? But this will only, the 21st clause under new CARO only applies to console, where the auditor will compile for every entity what are their individual CARO observations and put that into the console CARO. So, just to recap, I would just, there are questions around title deed. We talked about quarterly statements to bank. We talked about a lot of disclosures around investment, loans, advances, guarantees. We talked about unrecorded income. We talked about surrender of income. We talked about fraud. We talked about whistleblower, statutory dues, benami properties, and this whole requirement around loans and advances. So just to summarize, if you say there are questions around what do you do with the money which you get in as loans, borrowings, or whatever way? What do you do with the money which goes out in terms of investments, in terms of loans, in terms of advances, in terms of even non-loan item like guarantees and securities? So the whole idea, are you meeting obligations of somebody else? Are there any fraud reporting? Are there any going concern issues? So those would be, for me, some of the most important hot topics in terms of how companies are grappling with. And if you look at large corporates, which would have multi-tier systems, several group companies, and they have just given loans to each other, this is like a tough time for all of them. So with this, I just take the one requirement. I just said there's only one clause which has not been carried forward, which is around the managerial remuneration. If you look at managerial remuneration now is a part of the main audit report, so they are not expecting auditors to repeat that comment in the CARO. So that is the change which has happened. That is the only clause which has got deleted. But as you can see, there are so many of them which has got added. So it's a lot of work for both the companies as well as their auditors. And I will also just take 5 more minutes to, before I close this around, Mr. Chadha talked about having, talking about the 3 clauses which has come in the main audit report now. So this is something which has changed. It's an important change. Effective from 1st April 2021, there is the auditors will state that in their report that no funds have been advanced or loans are invested into with an understanding, whether in the record, writing or otherwise, that the intermediary shall directly or indirectly lend that money to an ultimate beneficiary. So I'll just make it summary. If you give any money to somebody with an understanding, whether it could be verbal, written, or elsewhere, that this money will be given back to somebody else. Or if the company has taken certain money with an understanding that they will pass it on to somebody else. In both the situations, the auditors will have to make a report. And that is, again, as I talked about, this whole kind of evergreening, the kind of using different layers to pass on money. That is the whole idea. And again, this is not a requirement which is there for specific company. This is for every company. So companies will have to carefully look at, are they not falling into this trap of money kind of passing? The whole money laundering is what the government wants to attack. And that is where they brought this clause out. And the auditors will have to carefully see that the money is used only for their business rather than for the just passing on as a vehicle to an ultimate beneficiary. So this clause is there for the March 22 audits, as must be happening now. And the other 2 clauses which are there was about the dividend paid. So they said, we want to see whether the dividend paid, including the interim dividend, is in compliance with Section 123. Section 123 not only talks about the computation, but it also talks about whether the dividend is paid into a separate bank account and a lot of other compliances. So that is a specific reporting which is coming. And the last piece is around this clause G, which actually says the company should have a accounting software which has a feature of recording audit trail for each and every transaction, and that should operate for the entire year. And the trail should not be tampered with, and the audit trail should be preserved. Now, this is the most, I would say, the most challenging for whenever we go to companies. This is the most challenging ones for even the little smaller companies, even for the larger ones, because to keep the logs, to keep the backup, to keep the system integrity, it's very difficult. But again, the idea is, as we talk today, we are already on 14th of kind of March, 13th of May, and this year it is live. So any company who has not done it, because this is applicable from 1st April 22, that means these companies are supposed to already have a qualification in their main report, because by now, from 1st April 22, this has been already deferred once, but next year the government looks like not in a mood to extend this further. And this will be an important challenge for companies to make sure that they have a system where there is a log for each and every transaction, and this trail, this can't be tampered with. So with this, I will close, and I'm looking forward to your Q&A and Vikas's session, my fellow speaker. Thank you so much, Mr. Chadha.
Some clarity and some practical insight onto, especially on a couple of clauses which some of our professionals will be struggling, especially when you talked about this clause for reporting any money given with the intent, written or otherwise, to give it to another person or received, which was meant for another person. What are the audit steps and difficulties in carrying out that activity? Because it's purely an auditor's own responsibility. We may, of course, have management to respond to our queries or representations. But as an auditor, what are the challenges practically, your team or people are facing in this regard? Because it can become quite difficult at times if there are large organizations, multi-locational, etc.
Yeah, thank you. So this is a great question. I think 2-3 challenges I would say. The challenge what we are facing today is this whole concept of money being fungible. The institute also guidance note also talks about fungibility of money. You could actually have situations where in life situations, we would see a company has a clear trail of money coming in and going to somebody else, but they have another money sitting in their bank account. Would you say that it was this money or that money, because money does not have a color? So that is one challenge in terms of how do we address and say, do we take the fungibility criteria or not? The second piece is in terms of the audit procedure, what you said. I think the easiest way what we do is we just do the old traditional inflow and outflow of funds. The best thing is just put all the inflows in a company what came in terms of which are non from your routine business, as you call it, not from business operations. Put all these special sources of fund. It could be loan fund, it could be borrowings, it could be anything from group companies, and then start putting a utilization and see that on one piece of sheet. If I'm the partner on the audit, I'll actually just see it this way and say, does it make sense to me? Because the whole idea is this has to also go out. If it comes to you, but it just stays there, then it's not something. That is where, of course, there are representations today, and the government has now asked the companies to make that disclosure in their financials. But maybe if something goes wrong, I don't think representations will really save anybody of us, because the accounts will show that. So the important thing for us is to just get the inflow and outflow of funds right outside your business operations, and hopefully that should be able to give this thing. The more challenge is around the guarantees and security. So there is any undisclosed guarantees and security, because they also cover that piece. That would be more challenging, I would say.
One more thing in this is there a special focus to be required, or maybe a dispensation or a way to look at it for if you are an NBFC or something akin to that? Will that create more trouble to comply with this?
Yes, I presume so. And I don't think that to my recollection, there is any thing for a company which is into the business of NBFC, and you can also kind of chip in there. But I don't think there is an discussion there. But again, the idea is NBFCs ideally will not borrow with an understanding to pass on. And I think it has come through only NBFC, because some of the NBFCs did it. And that's the whole challenge. That's a germination, I would say, is of this clause. But my sense is they again will have to do it. There is no way. The idea is you can be a laundering vehicle. As I said, you can't be a washing machine to get something in and get something out. So you just can't do that. That's the whole intent. And I'm sure NBFCs have to keep the records there, because the government, I don't think, is looking in dispensation for them.
Maybe Vikas, who does a lot of NBFC's audit, can throw light on this particular aspect, so that we can close loop this and then go back to my other questions to you.
Oh, I think Amit has rightly said that the entire thing has started from NBFCs only. That the NBFCs and banks were working as a vehicle wherein you have got the money from someone and then you have lent to someone. So it has looked like a normal business, but actually it was not their business, and they have got that money and given it to somebody else with the tacit understanding that it is the same money which is going, though it is not on the records. The challenge, in my view, is that if it is something not as per record, but otherwise if there is some understanding, how the auditor is actually going to find out anything about it. Because if there is an NBFC which is in the business of lending money, so they have lent money to somebody. Now, whether some money has come where there was an understanding to lend somewhere, it's really going to be challenging. And tomorrow, if something comes across, the auditors will find it difficult to justify. At the same time, auditors have no tool to find out. That's to my mind is the clear challenge.
So taking a cue from that, because if company A, who is an NBFC, gives to company B in the normal course of business, and the company B gives it to company C, which I may not have a privy to or control over. So the question is, as far as audit compliance of company A is concerned, I would have to establish whether there was any intent, covert or otherwise, for company B to company C, to give to company C. And if that be there, I have to report. So that's where the challenge is. If nothing is documented, and one, I may not be able to know the books of B, to know what has actually flown out, I think that's a bigger challenge. Intent is secondary. The actual flow becomes very difficult because sometimes it's in the scheme of things, how to control the balance sheet and activities of another company unrelated becomes a serious challenge in my view.
So what we have been focusing in this area primarily was that if any NBFC has given money to some other corporate, whether they have a robust mechanism to check the utilization of fund by the company. Okay. Because they have sanctioned it for some specific purpose, which is given in the sanction letter. So how is that company monitoring the utilization of funds by that company? If they are able to demonstrate that, and if as an auditor, I have documented that for my test check cases, I think that gives a lot of comfort that yes, they had given for this and they have documented the reasons. Beyond that, if there is any understanding, it is just not practical to find out.
Okay. Secondly, coming back to Amit, in CARO, those 50 clauses have been tinkered with, added, etc. So in your view, in practical sense, which are the most top 5 challenging ones as an auditor you faced in, in your limited 5-6 weeks of work, and what you give guidance to our fellow brothers and sisters to kind of maneuver that difficulty?
Yeah, and I said, I think for me, the biggest challenge as I was closing some listed companies, I think the challenge has been around the loans and advances given and investment made. So I think this whole concept of prejudiciality is very complicated, to say that this transaction is prejudicial. Somebody makes an investment in somebody, and after 3 years, a government nominee will have an insight of an hindsight and say this was prejudicial at this point of time, we should have seen it. So for me, this prejudiciality has been very challenging, and this whole funds movement in terms of how does the fund come in and go out, as you rightly picked up, the first question has been very challenging. But otherwise, I think companies are okay. If there has been 1 or 2 whistleblowers, then to address those in audit is now a very extensive exercise. And whistleblowers also today may not be all serious. In large companies, it could be a lot of disgruntled people who are just filing something against somebody else. But as becomes a part of the audit procedure, you will have to go through, see what management has done, yourself has done. It may not be relevant for all the audience here, but some companies, it has been a norm. A very large company, which have maybe 100,000 employees, you'll have thousands of whistleblowers. So what do you do there? But 2 or 3, the loans, investments, and something around this one.
Right. No, good. So we would request, our esteemed audience to also have question and answers. Probably we could take it at the end, combined, because there could be an overlap. And so without, thank you, Amit, so much, but do stick on because we need to pick your brains at some point of time.
Sure. Thank you so much.
Webinar, really insightful and very, your style of dissemination of these data and information was very simple, incisive, as well as comfortable to the listener.
Thank you so much.
I congratulate you for that.
Thank you so much.
Okay. So over to Vikas Kumar. He is a partner with TR Chadha & Company LLP and has more than 30 years of post-qualification experience. And he's the deputy CEO of the firm on a pan-India basis. He has a very extensive experience in bank audits, forensic audits, statutory audits, basically insurance practice, monitoring and business advisory services. Being based in Bombay, the mecca of finance, I think a lot of clients and companies who are interlinked to the financial world would pass through his area of work. And also he is actually an expert in doing various work on behalf of various regulators, ICAI, peer reviews, etc., quality reviews, standards, and be part of various committees and guidance setting bodies of WRC Institute, as well as SEBI, and etc. So over to Vikas. The amendments to Schedule 3, which is becoming now part of our DNA. When Schedule 6 was there, and when Schedule 13 came in 2013, all hell had broken loose. ये कैसे होगा, नई चीजें हैं, the whole format has changed, P&L is looking different, auntie is looking like uncle, uncle is looking like somebody else. So really don't know how to grapple with that. Still people are not so used to, the way the other comprehensive income, the way the structures are there. Maybe globally it's so different. And as Amit rightly mentioned, our kind of audit requirements and disclosures, and even the balance sheet disclosures, are probably a zillion times more than anywhere else in the world. See, audit report for foreign companies, the US is kind of a half-page thing. They will accept no qualification. Any qualification means the audit cannot be closed. Take care of that. So there is no story about giving subject to or disclaimer or any other kind of dispensations. Plus talking about 200 other things which normally an auditor who's wanting to look at financial statements and purely focusing on the chances of material misstatement being going under the radar. So the homework which they have to do to compile so much of data, which the managements have to actually, there is their responsibility. It's an added function. It's an independent activity more than the core concept of an audit, which we grew up to learn about. Because, ticking off various ratios, doing calculations, going here and there in terms of what is possible and what is not possible is rarely something which auditors enjoy doing. But nevertheless, that is what is there. And once you get used to it, then it becomes ingrained in the DNA. So I reiterate, the key thing is to train your youngest and the junior most employees. Anybody who comes to start audit have to be thoroughly retrained, and we ourselves as senior auditors, and, senior in age, have to go back to school, continuously educate ourselves, be abreast, so that we don't miss out on the whole concept of what is required of the statute, because the risks of are very, very severe. So over to Vikas, and I leave it to that. Thank you.
Yeah, thank you so much, Suman sir. Thanks a lot, and thanks a lot, PhD Chamber of Commerce and Industry, for inviting me over here and giving me an opportunity to interact with this August gathering. So thank you very much, all of you. What I have been told is to talk on the amendments to the Schedule 3 to the Companies Act. This is what I'm going to discuss today. And this is actually intertwined with what we have been talking in CARO. What has happened was that the changes in CARO came first, that the auditors have to comment on various additional items, which Amit has been talking in detail and telling all of you, right? So that was a clear worry from the auditor fraternity side, that we have to comment on so many items. Now, what government has tried to do, that by this amendment, many of the items which auditors need to comment and some other stuff as well has been asked to be done in the financial statement itself. So the companies itself will be now responsible to ensure that those things are properly disclosed in the financial statement. And thereafter, the auditors are giving it in their audit report, including the CARO report. So that's a key thing which has happened. And I think with this, a lot of balancing act has happened as compared to what it was, looking like everything is coming on the auditor's head. I hope my presentation, you all can view it, and I can go ahead with my presentation. Right.
We can.
Perfect. So as I have said, that this amendment which has come into the Schedule 3 is effective from 1st of April 2021. So all the accounts which have been finalized thereafter, and primarily, of course, for the year 21-22, which we are doing now, some of them we have closed for listed companies and others are going on. This is the first year in which it becomes applicable, and hence this is much more important for us to understand as to where we are and how we are going to take care of the same. Friends, as you might be aware, with respect to Schedule 3, that to whom the same is applicable, how the same is being given details. So as you are aware, this is given into three divisions. There are three parts to the entire stuff. First is with respect to the companies where the accounting standard applies. That's the first one, of course. The second one is with respect to the companies where Ind AS applies. So that is the division 2 on which the schedule 3 is applicable. And third is with respect to the NBFCs. So these are the three divisions, and the guidance note given by ICI is also there in three divisions because there are three separate set of accounts in the way it has been presented. So this entire thing is given into three parts, and the three divisions are applicable to them. Whole purpose of these amendments are to bring more transparency into the financial statement. Of course, that is the most important. And second, as I've already said, to align with the auditor's reporting, which we are going to do the reporting in the main report, in the CARO report. Just to give a perspective that what are the changes and how does it impact, there are total 35 changes which have been suggested in this schedule 3 for the companies. And as I was talking about division 1, 2, and 3, so out of this 35 changes, 23 changes or 65% are such which are applicable to all the three divisions, whether it is division 1, 2, or 3. So it means whether it is accounts are prepared as per accounting standards or Ind AS or NBFCs, all of them 23 is applicable. 6 of them are applicable only for division 1 and 2. 1 is applicable only for division 2 and 3. 3 is applicable only for division 1, and 2 is applicable only for division 2. So this is where the bifurcation of the entire 35 changes are there. When I'm going to talk on the changes, if you'll see on the right-hand side top of the presentation, we have mentioned division 1, 2, or 3, to whom the same is applicable. So that becomes clear that the point I'm talking, it kiske liye applicable hai, how we are going to look upon that. It shows accordingly over there, which I have tick marked. Some of them are very easy ones, normal ones, so we'll not spend much time. And wherever there are little more complicated ones, we are going to spend more time to discuss on the same. The first change, which is very simple, is on the rounding off of the total income, right? So earlier it was saying total turnover. Now it is saying income word. So turnover has been replaced with the income because there was a lot of different interpretation of the turnover which was coming earlier. So now they have simplified and they said, please consider the total income while doing the rounding off. Second change in this is earlier it was may. It may be rounded off. It means it was at the choice of the companies. Now the word uses shall. It means every company will have to do this. So if you have a turnover more than 100 crores, you have to show it in lakhs, millions, crores, or decimals thereof. You cannot use give the full amount, or you cannot give it in thousands or hundreds like that. So it has to be in lakhs, millions, crores, and you can mention the decimals there. So this was the change number 1. The number 2, again, it is a very simple. Earlier, it was actually only property, plant, and equipment, the heading under non-current assets. Now they have changed that heading to say property, plant, and equipment and intangible assets. So that is the heading that they have changed, whereas earlier it was not coming in the heading, whereas you were actually giving the intangible assets. So that's why they have brought this heading change. Second change here, they have said again, only a nomenclature is that rather than saying tangible assets, you have to say property, plant, and equipment. So these are the 2 changes just for the nomenclature which has come over here. The third change again is a very simple one. The lease liabilities, earlier it was shown in other schedule, but now it is forming part of the main schedule itself in the non-current on current liabilities. As part of financial liability, it will come in the main balance sheet itself and to be shown as separately as a lease liability. Next change is with respect to the changes in equity. 2 things specifically, if you see. One, they have added a column saying any changes in equity share capital due to prior period errors. I really wonder that how those errors will happen. But anyway, if there is any errors which has happened in reporting in this equity share capital, then you have to show it separately here to rectify it and mention that what was the total amount of errors, and then the restated balance sheet will come. This is the first change they have made into with respect to the changes in equity, and asked you to give a separate disclosure in that. On property, plant, and equipment, as well as in the intangible assets, another relevant change which they have done, they have said if there are any changes due to revaluation, right? So if there is any change due to revaluation, you have to give it separately. And if the change is 10% or more in the aggregate of the net carrying value of each class of property, plant, and equipment, then it has to be reconciled and given separately. So the disclosures will become more specific and clearer. This change is for both property, plant, and equipment as well as for intangible assets. This is again a very simple one, security deposit, which was earlier shown as part of the loans and advances, either long-term or short-term, or otherwise as non-current or current financial statement. So it was shown as part of the loan. This has been removed from loan, and now it will be forming part of the other non-current assets or current assets, depending upon the nature, whether it is current or non-current. It will be shown, but it will not be shown as part of the loan anymore. Otherwise, there used to be a lot of issues whether how the loan is so much, whereas most of them were relating to security deposit or something. So this is a good change which has come for the presentation purposes. One important change which has come in this schedule now is to give the details on the trade receivables, which we know as debtors generally. But so the trade receivables, earlier we were giving only outstanding for a period from the due date more than 6 months, less than 6 months. Now, and good and doubtful. Now they have bifurcated and asked various other details to be given. So this makes the reader much more aware on the trade receivable part of the company. So now the aging, number one, is that you have to give less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. So if you see, rather than 2 buckets, now you have to give in 5 buckets. That's the first major change which is there. Second, they have asked you to disclose separately on undisputed and disputed amount. So earlier it was only good and doubtful. Now you have to say disputed hai ya undisputed hai. In disputed also it could be good, and in undisputed also it could be doubtful. That's a separate issue, but you have to bifurcate between undisputed and disputed. Another thing which they have said, if there is no amount becoming due, which has so far, like less than 6 months, doesn't include the amount which has not become due. So if there is no amount due, you have to mention that separately. Similarly, unbilled dues. Now, earlier there's a lot of confusion where the unbilled due amount has to be shown. Somebody was showing in trade receivable, somebody was showing in other assets. So this will also form part of trade receivable only, unbilled dues, but it will have to be disclosed separately. Another major change, which is resulting into a lot of ambiguity, I will say, is that they have asked that with respect to division 2 and division 3, you have to mention specifically with respect to those trade receivables where there have been a significant increase in credit risk. Right? It could be good, it could be doubtful, but whether there is a significant increase in credit risk. If it is so, you have to give a separate disclosure on that. Now, that is not defined anywhere in this whole scheme of things, that where you say there is a significant increase in credit risk. So a lot of subjectivity will come over there. We, as a company or as an auditor, will have to see that what in respect to our company, which I am auditing, becomes eligible or becomes applicable. So suppose I am giving in general credit period of say 3 months, 4 months, then I have to factor it accordingly. But say my credit period is only 15 days. In such cases, even if there is something which is becoming due for 3 months, I will have to consider whether there is any significant increase in credit risk. If my normal credit period is say 6 months and something has not come for 3 months after becoming due, maybe there is not a significant risk. So that will differ from company to company, nature to nature, and case to case, which will have to justify and accordingly give the disclosure in that regard. So that is something which I believe is subjective, and we need to really focus on that while giving that disclosure. Next amendment, this is a new one with respect to the share capital, wherein the requirement now is to disclose the shareholding of promoters separately. Earlier, it was only more than 5% and other stuff. Now they have whatever is the holding of promoter, it has to be disclosed separately, and there is a table which has to be given for that. You have to give the name of the promoter, number of the shares they are holding, what is the percentage of those shares, and also one important thing here is the percentage change during the year. So as compared to last year, if there is any change in the promoter holding for the respective one, you have to give those details as well. So that will become very clearer with respect to what the promoters are holding, what are the changes happening in that, whether the promoters are selling, buying, how those things are moving. That gives a very good understanding to the reader from the promoter shareholding perspective. So this disclosure, this change has come. Another change, which I must say is a good one for a better understanding, which I've already talked about, is with respect to the lease obligations. So earlier, the long-term maturities of finance lease obligations were shown as part of the non-current liabilities in the borrowings. Now it is going to the main balance sheet and being reflected separately. So this is removed from here. Similarly from current item, but in current liabilities, you will see one more change which is there, which is with respect to the current maturities of long-term debt. As you know, if there was any long-term debt which any company has taken, So whatever was the long-term debt, the long-term component was shown as a long-term debt and as part of the borrowing in the long term. But the current maturities of the long-term debt was shown as other financial liability. Now, anybody seeing from the top of the balance sheet, they were not able to make out that how much is the actual borrowing of this company from outside, because this current maturities of long-term debt was being grouped under other financial liabilities. So this is now going to be shown as part of the short-term borrowings. So from this now you can see, okay, this much is the long-term borrowing, this much is the short-term borrowing. So total borrowings you can make out easily rather than going to other financial liabilities and trying to find out what is the component of borrowing which is grouped there as per the previous requirement. So now the current maturities of long-term borrowings are shown as part of short-term borrowings. So this, in my view, is a very good change, which will make the reader go through from the face itself rather than going to the schedule and trying to find out. Another important change, the way it was in trade receivables. Similarly, in trade payables also, now I have to give the aging schedule. The aging here, they have not talked of 6 months, thankfully. So there are 4 buckets which they have given over here, while we have to disclose on the trade payables aging. Less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. As you know, earlier itself, we had to disclose separately for MSME and others, so that we have to give it here also. Another important thing which they have mentioned here is on the disputed dues. So if there is any trade payables which is disputed, it means any litigation is going on or the company has disputed saying it is not payable and accordingly I'm not paying. So all those disputed dues will have to be shown separately over here. Again, between MSME and others, I'll have to give separately. Similarly, if there is no due date which is defined over here to pay, that what was the due date in which I have to pay, then I have to go from the date of transaction. Accordingly, I have to give the aging. If the due date is mentioned, then from the due date of payment, I have to give the aging. Unbilled dues, the way in trade receivables, we have to give the details of unbilled billing separately in the trade receivables. Here, unbilled dues, if any, it means you have bought something or you have bought some services, but the bills are not raised by the parties. So those are also payables only. You have to do the accounting as per the accounting norm. So those will be shown separately here as unbilled dues. I hope I am clearer and you are able to understand queries. Of course, we will take up at the last, but I hope I'm clearer so far. Going further, some of the important ones which they are going to come now. One is on the utilization of the borrowed funds. So if the company has not used the borrowings from banks and financial institutions for the specific purpose for it was taken, then we have to give the disclosures for the same as to where they have been used. Good thing is that we don't have to see that for the respective years, or the companies don't have to disclose for the respective years. This has to be disclosed at the balance sheet date. So at the balance sheet date, if the company finds that there is any amount which they have borrowed and could not use for the specific or intended purpose, they have to give a separate disclosure for the same in their financial statement. It becomes applicable for all the divisions, whether 1, 2, or 3. Bank notes, it's not required now, so they have omitted. Title deeds, Amit was also talking while talking on the CARO. So this is an important change wherein they have said if there is any title deed of immovable properties which is not held in the name of the company, then this has to be disclosed separately. And you have to give that disclosure for each and every item for which you do not have. You also have to disclose in the financial statements if this title deeds, if not in the name of the company, then whether it is in the name of a promoter or director or relative of promoter or director or employee of promoter or director. So all of them, if it is there, it has to be disclosed separately. You also have to mention ki kab se hai. It means since when this property is held in the other name and not in the name of company, that has also to be given. And again, very important, the reason that why it is not in the name of the company, when the money is paid from the company, when the amount is being reflected in the books of the company, why it is not in the name of the company, you have to mention the reasons also there. So this becomes a very important disclosure and it will bring a lot of transparency, we believe, while coming into the financial statement. Another disclosure requirement which is there is that if there is any revaluation which has happened either for property, plant and equipment or investment property or intangible assets. So if there is any revaluation which has happened, then the company needs to disclose whether this revaluation is based on the valuation done by a registered valuer. So there is a specific requirement now that the valuations need to be done by a registered valuer. So that disclosure will have to come clearly stating that this valuation is done by a registered valuer. In case if it is not done by a registered valuer, then it will have to be mentioned accordingly and to be taken care of it. Loans and advances, again, Amit was talking on the same. So now this company also will have to disclose in financials if they have given any loans or advances in the nature of loans to any of the promoters or directors or KMPs or any of the related parties, which is defined as per Companies Act. Then those loans which have been given are either repayable on demand, or there are no terms or period of repayment which is defined therein. In those cases, that disclosure will come separately, saying that, okay, I have given money to so-and-so director or so-and-so promoter. This is the amount outstanding, and this is only repayable on demand, or there is no repayment period defined, or there are no terms defined. So that disclosure will come. Another important thing which they have mentioned here is that you have to mention what is the percentage of this loan as compared to the total loans and advances given by the company. So that percentage will also come. So that will bring some understanding that how material it is in terms of the company to whom we are talking about. But this again is a very important disclosure which will have to be met by the companies. Yes, friends, now going forward, the way we talked on the aging with regard to the trade receivables or trade payables, similarly now for capital work in progress also we have to give aging. This is in 4 buckets which we have to disclose: less than 1 year, 1 to 2 years, 2 to 3 years, and more than 4 years. So this is the bucket in which the disclosure has to happen. Also, all this capital work in progress, you have to bifurcate between 2. Number 1, projects which are in progress, and number 2, projects which are temporarily suspended. So if there is anything which is under suspension mode, that comes separately into it and gets disclosed. So it becomes very clear that what is happening and where it is going. Not only that, one important disclosure which is being required now, that if there was any project which was going on and the completion is overdue, you had planned for 2 years, 3 years, and that's how it is recorded, and it is becoming overdue now, it is taking longer time. Or also if it is exceeding its cost compared to its original plan. So the plan was to do this project in 50 crores, now it is exceeding. In both the scenario, where the completion is overdue or it has exceeded the cost, then both the scenario you have to give separate disclosure project wise now. The earlier disclosure was in totality, like what are the projects in progress, total amount you were showing only for the aging period. But here project wise you have to disclose and say that what is this project and what is the when it is going to be completed. So it's not only since when it is pending, you have to give those project details and say that yes, this is overdue, but and this is how, and this is much time I'm going to complete, less than 1 year, 1 to 2 years, 2 to 3 years, like that. So this becomes very onerous, because if there's overdue, then whether it is going to be completed in time, no, then why there is no due provisioning, or it has exceeded cost, then what is going to happen, when it is going to complete. So all those disclosures are coming and will focus even from auditor side to see how they are dealing with it. The way it was for capital work in progress, similar thing is for intangible assets under development. Same aging bucket, same for progress and the suspension to be shown separately. Same like if the completion is overdue or has exceeded cost, then you have to give project-wise details with the details when you are going to complete. Similar disclosures are there, the way it was for capital work in progress. We go further now. This is on the Benami property, right? So it is coming in CARO also, as we have been talking before. So first thing now is CARO will come fine, but first the company has to disclose. So what has to be disclosed? If there are any proceedings which have been initiated, so it's not that it is decided that it is a Benami property or not. If the proceedings have been initiated or pending against the company for holding any Benami property, so if there is anything which is initiated or pending, you have to give disclosure. So it's not that it is concluded. So the moment it is initiated, the moment it becomes pending, you have to give this disclosure. So disclosures will include which are the properties, when it was inquired, what is the amount, what are the beneficiaries, whether it is in the books or not. If it is not in books, then the details, where it is and how it is, where are the proceedings going on, what is the nature of proceeding, what is the status. So complete biography, I'll say, or history or geography of those properties will have to be given and to be disclosed in the financial statements. Another disclosure, which is actually very onerous and challenging, is with respect to the borrowings on the basis of security of current assets. So if the company has borrowed any money at any point of time during the year from banks or financial institutions, and those borrowings are on the basis of security of current assets, in such case, they need to disclose these two things. Number one, whether the quarterly returns or statement of current assets are filed by the company with banks and institutions, and they are in agreement with the books of account, right? So every quarter they are filing, they're saying this much is my trade receivables, this is my inventory, this is my trade payables. So those disclosures are given by the company. Now the company will have to check that, yes, what I have filed with the banks or institutions, it is matching with my books of account. If there is any amount which is not matching, because it is possible that you are disclosing that to the banks or institutions by a cutoff date, say somebody is disclosing by 15, you could not do the entire accounting at that point of time. Say it is for June, and you have to file by 15th July, and the entire accounting on the inventory valuation or debtors or the recovery reconciliation could not be completed. Something is X in the books of account, but later on you updated that, and you find that the books of account on that day is different from what you have filed with the banks or institutions. You have to give those details, and you have to explain that what are the reasons for the same if those discrepancies are material. So this is something which has to be disclosed by the management first, and then of course what the auditors have to do from CARO perspective is already explained by Amit, that how do we really go about it. Willful defaulter is another one which the company has to disclose now. In this case, the good thing is that if the disclosure will come only when the company has been declared as a willful defaulter. It is not when the process starts. So the process starts, then it takes time, the notices come. Those type of things we don't have to, the company has not to disclose. But once they are declared as a willful defaulter, then they have to give this details saying when they have been declared as a willful defaulter and what was the amount of default, what was the nature of default, why they have been declared as a willful defaulter. That will have to be disclosed in the financial statements. Relationship with struck off companies. This is again a very, very important and a new and important change which has come in the financial statements to be disclosed. So here, if there are any companies which are struck off under Section 248 of the Companies Act or under Section 560 of the Companies Act, in such cases, if you have any transactions with those companies, whether it is in the nature of investment in securities, or it is receivables or payables or shares held or any other outstanding balances. So any transactions with these struck off companies will have to be reported, and it has to be reported company wise, that what is the name of that struck off company, what is the nature of transaction done with them, what is the balance outstanding current year, previous year, and what was my relationship, if any, with that struck off company. So all those disclosures will come. Now, the challenge here was how to really find out the list or the name of those companies which are struck off, because there are different ROCs in India, more than 20 ROCs in India. And as we understand, everybody has their own list. That list also keeps on getting updated. So now there are a lot of software coming, a lot of data is coming, wherein the entire list is getting merged and coming. Otherwise, the companies can take those lists from the respective ROCs, combine it, and then compare it with that list with the transactions which has happened during the year with those companies, and accordingly find out and give disclosure. So this will entail a lot of work, but there's no other option. It has to be done, and that disclosure has to happen, because tomorrow, if something else comes, then the responsibility or the onus will come on the companies as well as for the auditors to report on the same. Another change, or the important change which has come now, that now the registration of charges or even the satisfaction with the register of charges, right? So if there is any charge or satisfaction which is yet to be registered, so you have created a charge, but it is not registered, you have to disclose. You have satisfied, but you have not, the registration has not happened. It is not yet recorded with MCA. You have to disclose. So all these cases where the charge register of registration of charges or satisfaction are yet to be registered with ROC beyond the statutory period, then we have to disclose the same with the details and the reasons. This becomes applicable for all sort of companies, whether it is in 1, 2, or 3. So this needs to be disclosed. The next one is with respect to the compliance with number of layer of companies, which Amit was also talking, because it has to be commented upon also. So here, if the company has not complied with the number of layers, which is specified under the Companies Act already, if that is not done, then we have to give the name, that what are the number of layers of companies, what are their name, what is their SIN beyond the specified layers, and what is the relationship, extent of holding in such downstream companies or upstream companies. So all those details will come and to be mentioned if we have not complied with the layer of companies which is specified. Another important or onerous task which has come is to explain, to give the details, number one, on all the ratios. So different ratios they have given. For division 1 and 2, they have given what are the relevant ratios, and for division 3, which is NBFCs, they have given different ratios which has to be disclosed. Division 3, I think, is not an issue, because that was anyway getting covered as a CRAR ratio as per the requirement of RBI. Now it has come in the Companies Act also. Division 1 and 2 is more important, because these ratios, sometimes earlier the company was giving on its own as a good corporate governance practice, but now this has to be disclosed as part of the requirement of the Companies Act. So these disclosures include with respect to current ratio or debt equity ratio or DSCR, return on equity, inventory turnover, net capital, NP ratio, return on capital employed. So all these ratios will have to be given. You not only have to give the ratios, you also have to explain the numerator and denominator for all these items. So how you are calculating these ratios, what are the numerator and denominator will also have to be given in the financials itself. Another important change which they have said, or requirement which they have said, is that you are giving these ratios fine. You have computed and given for current year also, for previous year also. For any change, I mean, you all must be aware, and you are aware that anything which I am giving, we have to give for current year as well as previous. That's the basic and fundamental requirement. So in this case also, I am giving the ratios for current year as well as previous year. And if there is any ratio which has moved more than 25% as compared to the previous year, then I also have to give an explanation that why this change is there. How come it has moved beyond 25%? So that also will have to be given in the financial statement. Next is with respect to the scheme of arrangements. So if there is any scheme of arrangement which is approved by the competent authority, then the company must disclose the effect of such a scheme of arrangements and its accounting in the books of account. They will have to confirm that these accountings which have been done in the books of account is in accordance with the scheme as well as in accordance with accounting standards. Because now you cannot have anything which is, okay, if it was that part of the scheme and that's why I have done it. Those things have to be in compliance with, in accordance with the accounting standards as well. So that disclosure will have to be made and mentioned very clearly in the financial, that this is the scheme of arrangement done. This is the approval by so and so on this date. This accounting has been done in the books of account. This is in accordance with the scheme. This is in accordance with the accounting standards. In case if there are any deviations, that will also have to be not only disclosed but explained, but also as to why this deviation is there, because it is supposed to be in accordance with this scheme and accounting standards. Okay, this which we were talking also earlier as to how we really the company or even the auditor will look into that. So this is with respect to the advances or loans or investments with some further understanding. So if the company has given any advances or given any loans or invested any funds, and mind it, this fund could be out of anywhere. It could be out of borrowed funds, it could be out of share capital, premium, or any other source of fund. So from wherever amount has come, that is not important. But if you have given any advances, loans, or invested funds, and again to any person and any other person of the entities, including foreign entities, with the understanding that the intermediary, yani jisko main paise de raha hu, the entity to which I am giving money, if that intermediary shall directly or indirectly lend or invest in other person and entities identified in any manner whatsoever by or on behalf of the company. So if I have given money, I have given invested money, I have given advances, and I have told that person that, okay, I'm giving you money or I'm investing the money with you, you will give money to so and so, or you will invest money in so and so. In that case, this disclosure will have to be given in the financial statement. And this is not only for advances, loan, or investments, it is also for guarantee or security or the like, or on behalf of the ultimate beneficiaries. So if there is any such case, we have to give those disclosures in the financial statements. What all to be disclosed is given here, that you have to give the date and amount, how much you have invested, how the ultimate beneficiary is going to get, how much they are going to get, and how, again, very important, how the relevant provisions of FEMA and Companies Act have been complied with for such transactions, and there is no violation of Prevention of Money Laundering Act. So that disclosure will also have to come. So this is something which is, in my view, one of the most important disclosure which is going to come from the companies first, and then of course to be seen and reviewed and audited by the auditors as well. Some other few changes, not very relevant, but still now rather than the word revenue for the total revenue, because it was including revenue as well as other income, so they have said it is not a total revenue, it is total income. So they have changed the word revenue to income. Similarly, in the revenue from operations, they have added one item here, that is the grants of donations received. So if there is any grants or of donations received, that will be added as part of the revenue from operations. Undisclosed income. This again is an important thing, that if any company which is preparing its financials and they have done any transactions which is not recorded in the books of account but has been surrendered or disclosed as income during the year in the tax assessments, in such case they have to mention and disclose such surrendered item or disclosed item as income tax in their books of account. They will have to give the disclosure. Not only that, if they have any previously unrecorded income, previously also if there was any unrecorded income and the related assets which have not been covered in the books of account, then in that case also it will have to be disclosed in the books of account. This, as per the guidance note which is given by ICI, primarily relates only to the voluntary admission. So say there is any survey happened or search happened, during the course the company has disclosed something or surrendered something and agreed to something, and they have not reverted back on that. They have not gone back on that disclosure. So in that case, it remains as a voluntary admission. Such cases will have to be mentioned here. If there is something where there is a case going on, the department has added something and they have said it is not done properly and all that, that is not something which, as per guidance note, has to come over here. But if there is anything which is a voluntary surrender or voluntary disclosure and not retracted later on, such cases will have to be disclosed over. CSR, the focus is increasing on CSR on a very regular basis, as you all are aware, and there is a whole lot of requirement to do all the necessary things as per the CSR requirement. So earlier also it was required. So now some more things have been added, and all those disclosures are required. So in case of CSR, the companies have to mention what was the amount required to be spent, how much they have actually spent, what was the shortfall at the end of the year. If there was any shortfall at the previous year, that has to be given. Reason has to be given for such shortfalls. What are the nature of CSR activities you're doing? If there are any related party transactions with respect to those CSR activities, those will also have to be disclosed. If there is any provision done, then the movements in provision on that. So all those disclosures will, which is becoming a little more lengthy now, will have to be given by the company in its financial statement. The last one is with respect to the cryptocurrency or virtual currency. So if the company has traded or invested in crypto or virtual during the financial year, then this disclosures will have to be given, which is on the profit or loss on such transactions, amount of currency held at the reporting date, and deposits of or advances from any person for the purpose of trading and investing into such currencies. So this is a disclosure which will come if you're doing anything into the crypto or virtual currency. I think these were the crisp of the entire changes which has come into Schedule 3. Looks that it is not that easy. There are a lot of work which will go behind it while doing it, and the companies will have to definitely spend more time and energy to ensure that these are disclosed properly, because tomorrow later on if something comes, then it will become much more challenging. That's it from my side, and if there are any questions, then we can take it.
Yeah, thank you, Vikas. That was very insightful and quite detailed, as well as very swift in terms of what really matters for all of us. So we can close a little early, Shivani. So what we'll do is, if anybody has a question, they can put on the chat. Shivani, you can just let me know, and then we can check with whoever is required to address that. Because I have a question. You see, now the Schedule 3 requirements are the responsibility of the management. And how much do you think, the auditors can play a role in educating the clients and help them in compiling this data in terms of seeing that they compile the correct data? So any training or any kind of exposure to the finance team is being envisaged normally, or how does it work?
No, I think this is very important, and I can mention that once these changes had come, on a very proactive basis, most of the audit firms have been in touch with the companies to make them understand the nuances of all these changes which are there and how they are going to do it, because they had to do it not only for the March 22, the current one, but also for the previous year. So this working had started, in my view, long back, and all the large and medium-sized companies at least have been working on the same and being in touch with the audit firm as well wherever required to see to it that the understanding is correct and this disclosures and this updations come properly into the financial statement. And in fact, many of them, as I have said, or Amit also said earlier, is also impacting my CARO reporting. So it is definitely auditors will have to be also ensuring that those which is in fact impacting the CARO are ensured totally and corrected and disclosed properly into the financial statement. Even otherwise, we have to see that for other items as well based on the materiality and the other stuff. But the items relating to CARO will have to be done 101%.
Okay. We have a few queries already, so let me see if I can capture. And go with the last one which came first. Last one's easy for me to scroll up. So if a person comes under promoter as well as director, where to mention?
So this, I don't know, they are asking for this query from which disclosure perspective. If it is for promoters shareholding, then of course, if it is promoter, then it will be reflected in the promoters shareholding. If it is for loans and advances given, then definitely, I think in my view, the right way will be to mention as a promoter and director rather than only promoter or director. The better way will be to mention the same as promoter and director and do the disclosure.
Okay. One question is on leasing. What will be the reporting if there is no signed lease agreement in particular period, but tenancy is months to month? Tenancy and the rent is being paid on the basis of expired lease.
So I think in leases, what the requirement is only for those leases where it needs to be capitalized. If it is an operating lease, where we are just taking something premises on lease and I am just paying them a rent, and it is not it is only an operating lease, I don't think it becomes applicable for that. It is for immovable property. So those leases which will have to be capitalized for our purposes as right of use assets or otherwise. In such cases, we have to give the disclosure if the agreements have not been done.
This could be taken by Amit. Now we have, two queries. One, any change in reporting if the company has given performance guarantees to customers?
No, so I think for performance guarantees, they would not be. Actually, it actually says the guarantees given to any other parties. Now we will have to see whether performance guarantees get covered. That is something I'm not sure whether initially we never used to cover it, but I think they brought this clause any other parties. So that is something which needs a little bit more examination, to be honest. And that I think is a good question to be kind of. Maybe I can respond separately. My email ID is there, but I can have a look at it. But yes, if you have any view on this, you were one of the part of the guidance notes. So
Vikas, you can.
In my view, sir, the guarantees which they are looking upon prima facie is relating to something which is relating to financial instruments. So it is like loan, or you have given a guarantee. So it means you are exposed to that. Performance is relating to the operations. So in my view, prima facie should not be included, but as Amit has said, it will be good to check further.
Yeah, and I think you're right. To one extent, it actually says a few places that it should be only financial guarantees. I think the guidance note actually specifies that. But essentially, the only question comes to any other parties now, whether you really want to classify it and go too hard on that one. That is something needs more examination.
Right. So this is one, yeah, I think there is some notification and this would be important to clarify. The audit trail now required for in your accounting software like Tally, etc. It is from 1st April 22 or 1st April 23.
It is from 1st April 22.
So
Very clear,
already,
April 22.
Yeah, so that's why I said we are already 45, 43 days into the new regime. So anybody who has not done it as of now, I have seen clients who have come up and said that, oh, this is already 1st April passed, what should we do? If they are setting up now, then essentially we expect some sort of a disclosure because it says for all transactions during that period. So if you have not done it, a company has not done it, then essentially we expect some reporting already to come in the report.
So in this case, I think, my friends, the best thing is if you're not a listed company or not requiring to close audits quickly, etc. But from 1st April 22, if you're going to do the audits in sometime in September 23, and then you tell your client that, no, you should get the audit trail, otherwise I'll have to make disclosures, qualifications, etc. That will be pretty unfair on the client. They may be aware, they may not be aware. One, they may be aware, they don't know how to implement it, what is the kind of checks and balances they need, the processes, etc. So immediately you must send a circular, speak to all your clients, all the corporates, small, big, large, that if they have a Tally software, they have to pick up the phone, speak to the Tally guys, tell them that I need this feature, the Tally people have this feature, pay a little more and get it installed ASAP. Simple steps. I'm kind of, so that's what we are expected to do. So all the clients, most of them may not be aware of it because, that's the time when audit comes months and months later, even if you're doing it for quarterly. Large companies would have ERPs, but smaller companies will not have ERPs and they have simple Tally or some other software. There is going to be a serious challenge. And even in larger ERP system, this feature may have been disabled or not kind of energized or paid for. So that also has to be done because then it becomes all the more onerous. Large companies having exposure to different verticals, branches, etc. Everywhere this has to be standardized and brought into fore.
Yeah, and I think the other challenge which I've seen a lot of companies have practically asked me and asked in terms of what exactly it means for what items a trail should be kept. Is it only the financial records, or is it something, let's say an inventory module in an ERP, or let's say an HR module. So let's say if my attendance, which also impacts my payroll cost, it is as a financial statement overture, then whether those systems should be absolutely foolproof. So how long we should extend it, or how far we should extend it in a company. Do we only extend it to the books of accounts, or do we extend it to say if my attendance record can be tampered with in the software or does not have an audit trail, then and it has theoretically a financial statement implication, do I go that far, or do I go to my inventory management system? So the MM module in SAP, whatever you call it, material management. So some of those could be again challenging, but the basic thing is at least the books of accounts, what generates the trial balance has to be there in the first instance.
Right. There's a question, if a company has taken security deposits from its customers / dealers against supplies, any specific disclosure is required?
So in my view, there is no change which has come in this regard during the year. So we have been showing it as a liability in our books the same way, the way it was being shown earlier as a liability in the books, it will continue to be in the similar fashion. So if it is a financial liability or otherwise will have to be identified and to be shown accordingly in the books of account.
Yeah, if it is only security deposit, I concur to Vikas's view, that's how we should be. And the only thing is that we have to just be sure always around the deemed deposit provision section 73 to 76. So if you have those deposits, the customer's balance continue to be there, there's no business more than 365 days for sale, purchase of goods and services. Sometime gets into that angle, but otherwise I don't see a new reporting.
Okay. I'm not seeing any more question. If there are, please come up. I think we were wanting to wrap up early, but this is fine in case we have. And if there is any question, they can always write to the PhD or specifically to the Corporate Affairs Committee. And at any point of time relating to corporate laws, implementation of CARO Schedule 3 and so many other new laws, which are coming every day. Anything which we haven't envisaged also, now we have a new, the report also, corporate report, CLC. So that also may have far-reaching implications on documentation. So this is a point on the audit trail, because I also read somewhere, so I was not very sure, but what Poonam is saying, that the company's account rules 24 notification dated 31st March, the audit trail date has been extended to 1st April 23.
Okay, we will check that. Yeah,
I think that's true.
I also was looking at it. Maybe
I did read it somewhere, but in the milieu of audits, etc., I probably missed it out because it wasn't relevant for March 22. But she could be correct, and we stand corrected. We can just Google it and find out and let them know even before the program ends.
Yes.
Amit, can you do that?
I'll just confirm that. Yeah, please. Yeah, because I think that's something I also thought.
It is now 1st April 23.
That's what I thought, because that's why I was, we were trying to bring up a little PPT on this, but we took it back.
Yeah, because it's already been extended twice now. So it's like they started with 21, they went up to 22. So yeah, you're right.
Thank you, Poonam, for that. Really appreciate.
Yeah.
Another query: how are the loan given to Esop Trust to buy shares of the company will be reflected?
In the financial statement or in CARO? I think
I don't know. This is a question, so I don't know how you want to address this.
Vikas, you want to take a shot and then I'll.
The question is, how are the loan given to Esop Trust to buy shares of the company will be reflected?
So the trust will be a related party to the company because it is made by the company itself. So it will be disclosed as a loan given. I don't know what is specifically he's looking for, Mr. Anil, but broadly the disclosure will come in the same loans given schedule, and it will be disclosed as related party transaction.
Will it be talking about because they are being given to buy the company shares? So is there any further responsibility or disclosure or provision on that? I'm not sure.
I'm not sure if there is anything further into it.
Okay. No, good. I think that's been a very, very exciting afternoon. So we have an audit trail. There is a change in attendance, which will eventually impact actual valuation and will have financial impact. Hence, do we need to ensure this as well when applicable? So on audit trail, basically, to my mind, let's keep it simple to the accounting books only, the general ledger, cash book, etc. The debit and credit entries where the trial balance is generated. The other activities like attendance, etc., I don't think it is being extended to that. And luckily, as we were rightly pointed out, it's not applicable till next year. So over the year, we'll have a lot of more clarity on that, and maybe they will give some further guidance. And there may be this and some other several points which we need to be addressed. And people will actually have to engage with the software consultants and software providers to be able to change that, because that itself will take more time. It's not that I tell my ERP guy that from today I have to have this trail, and it is with a switch they'll be able to do it. They will have to be able to configure it in a more structured manner, and there'll be test runs and other aspects which they will need to have to consider. So thank you, everybody. Thank you, Amit, and thank you, Vikas. This has been a very enriching Friday afternoon. We have a long weekend, but many of us will be working because of the timelines and deadlines. And the summer has hit Delhi. It's going to hit 46 as a heat wave. But maybe let's hope there's some respite. Last week we had some respite from Odisha's, some cyclone. This time next week we have some respite from the western disturbances. So I hope it brings some rain and cheer to this dusty little city. But Delhi is fun all throughout the year, the way you see it, and you can always enjoy as well as work efficiently as long as you are able to balance your work-life situation, work from home or work from office, or hybrid. All that is happening. Main thing is to be safe, take care of yourself in spite of the precautions being low, keep masking, meet in open gathering and not in the closed gathering, and try and, keep that social distancing. Over to Shivani for concluding remarks.
Thank you to our esteemed speakers. Your session for today was very enlightening. You threw light on all the latest amendments and clarifications, and you had enriched all our delegates also. And regarding their question, we received this, can we get PPT? They have asked like many times. We'll be sharing the PPT after after the webinar, maybe on the next working day on Tuesday. We'll definitely share it with everyone. So on behalf of PHDCCI, I thank Mr. Vikas Kumar, Mr. Amit Gupta for sparing your valuable time and enriching us on the topic. And we would like to thank the sponsors, TRC Consulting, for joining hands in this webinar. And thank you, Suman sir, for always being the guiding light for us.
Thank you. And whoever there are on the call today on Zoom, let us know what subjects really interest you. You want us to do a workshop or a physical webinar, seminar. What are your preferences now? Because people have gone to physical thing, and there has been a Zoom fatigue, as I call it, because that is over the 2 years we have learned that. So we can go back to physical. Let's look at that option as well. But do share your input as how do you want us to address it, and what topics are really burning the industry as well as the professionals today. Thank you very much once again.
Thank you, everyone.
Thank you. Thank
Have
you,
a nice
everyone.
day.
Thank you.
Thank you,
Bye.
sir. Thanks, Shivani. Thanks, Amit. Thanks, everyone, for attending. Thank you. Bye-bye.
Thank you, Mr. Chadha. Thank you, everyone.
Yeah.
Thank you.
Okay, Amit, I'll be in touch with you. Thank you.
Yeah, thank you. Bye.